Well, another Fed day has come and gone, and we got exactly what we had anticipated. The Fed announced a 1/4 point cut to that Fed funds rate, but more importantly, what's going on with future interest rates and what did the Fed have to say with regards to its comments about more rate cuts and what they are looking at to help them determine the path. What's going on, y'all? My name is Kevin Weedmark, aka The Mortgage Mouth, coming to you with another episode of the Daily Dose. Make sure you hit that subscription button so you never miss a beat. And like I said, we got exactly what we anticipated today. There was no way we were going to get a 1/2 point with sticky inflation and basically 2 months of indications that the economy is slowing from a labor perspective. However, what the Fed did say today, now in the comments in the presser, it's basically now acknowledging that the labor market is deteriorating. That is now their primary focus, although they continue to have the language that they're going to, inflation is elevated, something that they really need to pay attention to, something that they will continuously evaluate the data to make future decisions, and that we can anticipate potentially 2 more cuts this year, as now a lot of their ammunition and where their focus is based on current data, let me preface that, is on that labor market. However, they did clearly indicate that inflation is sticky. We can see it. We're sitting at a level of about 3%, and they once again reiterated that their target rate is 2%. That's a significant gap. That is a long haul to go, given that we've had these elevated Fed funds rate for quite some time, well over a couple years, and it hasn't brought that Fed target rate down to the 2% level. So they do basically acknowledge their dual mandate of employment, as well as the interest rate side, as well as, I should say, the inflation side. But the big news is much of what we thought was going to happen happened. And now what's happening with interest rates is you're seeing the reaction of, okay, we got what we wanted. We're going to see a little bit of a rally in the markets. We're going to see a pullback in treasuries, which is exactly what we anticipated, because the fact is these rates were already baked in. That 1/4 point cut and the next 2 cuts are already baked into the 10-year treasury. So you're not going to see a significant difference other than data that needs to come out. And we need to see 2 things. We're going to need to see inflation come down a little bit, and we're going to need to see an economy or a labor market that continues to deteriorate. That will be what will significantly move interest rates, move them into the high 5s, and it will do it permanently to the mid 5s. All right, y'all, I'll be talking to you tomorrow. Let's see what the reaction is after a day of digestion. Cheers.